Good morning. My name is Jack Crawford. I'm the founding general partner at Impact Venture Capital. We're launching a corporate venture video series today, and I'm thrilled to have a chance to interview James Mawson, the CEO of Global Corporate Venturing. Good morning, or I guess good afternoon in London today for you, James. How's it going today?
Well, Jack, it's a great pleasure to be here. I'm really looking forward to catching up and having a good conversation today.
Well, I understand you had a little American football out in London this weekend. I don't know if you're still buzzing about that and you've converted over to American football, or you're still a soccer fan.
Well, I think still the majority of people are still supporting soccer, but I think we had 80,000 fans in Wembley and it was a full house. So I think American football certainly converted a few more after the weekend celebration.
Well, thanks again for making time to talk with us today. From previous conversations and previous meetings, you're literally one of the world's experts in global corporate venture capital, and so I'm thrilled to have the audience learn a little bit more about your background and your organization, and then pick your brain a little bit about some of the interesting market trends as it relates to corporate venture, an area that we're quite interested in. Just to start, James, can you talk a little bit about sort of the migration from, in effect, the journalism profession to playing this thought leadership role in corporate venture? I mean, there's been other journalists that have made their way successfully into the venture capital ecosystem. Moritz at Sequoia and Mary Meeker at Kleiner. It'd be interesting to hear about your sort of transition from journalist to playing a key role in the venture ecosystem.
Sure. Well, thanks, Jack. I mean, hopefully I still consider myself a journalist first and foremost. I think what I was quite interested in, I spent 4 years or so at Dow Jones. They acquired a previous publication I was working for, and so I was the private equity and venture capital editor in London for them. And so when I was leaving Dow Jones to set up this company, what I was quite interested in is that the thought that coming out of the global financial crisis, that we would see more involvement and engagement in that innovation capital ecosystem. So what I really wanted to try and do was understand how corporations in particular, but also governments and universities would be more engaged, provide more money and more support to the entrepreneurs, and effectively make the world a better place by better and more efficient allocation of capital to the real entrepreneurs who wanted to make the world a better place and change that world for the better. Have that impact, I think, which is why I think your name probably, Jack, is probably more on point than almost anyone else I can think of.
Well, and just to give the audience a little bit of a deeper understanding of you as a person, is there something outside of your public bio that people would find interesting or unique about your background or interests?
Yeah, well, that's a tricky question, actually, Jack. I mean, one of the things I felt of why I became a journalist 20 odd years ago was because I was more interested in other people than perhaps I felt that other people would be interested in myself. So there's not a lot, I think, about my life that would be particularly interesting. I play a bit of cricket. I used to play a bit of soccer, and I very much just try and listen to other people. I've always found I've been the least interesting person in any room I've been into, if that's not too modest.
Well, that's overly modest. What I have found about you is your ability to actively listen is something one of my partners, Dixon Dahl, talks about quite frequently. Successful entrepreneurs have the ability to actively listen, and they absorb more information and learn more from the people that are around them. So I would sort of put you in that category. Let's talk for a second just about your organization. So Global Corporate Venturing effectively is doing a number of different things. It's part publication, part sort of mobilizing and sort of tracking corporate venture across the country, here in the U.S. and around the world. There are organizations, as you know, like the National Venture Capital Association and the Kauffman Fellows. Can you describe how your organization sort of collaborates or fits in with some of these other organizations that are tracking maybe what's going on in the U.S. or what's going on with venture in particular, but you seem a bit differentiated with your global view and with your focus on corporate venture in particular?
Sure, happy to do so, Jack. I suppose what our starting point was when I was leaving Dow Jones was very much to try and say, who does corporate venture? and what are they doing? Very much try and get the sense of how the overall venture ecosystem is developing and what role does, in particular, the corporations play within that. So with the trade paper, we're trying to answer those two questions by talking to the 2,500 corporations around the world that invest in directly in the startups, get a sense, therefore, of who the people at these organizations, how they think, how they're trying to operate. Are they much more focused on supporting the entrepreneurs or supporting the parent company? And therefore, are they looking more for financial returns or more strategic returns, or a bit of a mixture of both? And then by looking at those deals and understanding what they're doing to support those portfolio companies, if you think about those portfolio companies' 5 basic needs: capital, customers, product development, hiring, and an exit, understand therefore what they're doing as corporations to deliver on that exit and the value creation that could be provided through that journey from the entrepreneur's point of view. And then as a company, what we're trying to do is to say, hey, how can we help? What are we doing that's allowing you, by understanding your role within the ecosystem, to do a better job? How can you learn those best practices from your peers? And then through the events that we do in California, New York, Houston, London, China, as well as Brazil, Canada, Singapore, Russia, and a host of other countries, is say, hey, let's bring the community together, bring you together with your peers in the VC, in the independent venture capital world, and therefore hopefully start to make things a little bit more efficient.
Sure.
And then the final piece that we do is bring that community together digitally, or as well as through the events, to say, hey, if you connect up with your peers, you might be able to share some better deal flow and better ideas. So almost like a mini LinkedIn, I suppose. And that's what we call the GCV Leadership Society.
Okay. James, in all honesty, has the rise of corporate venture over the last 5 years surprised you? I mean, I can tell you, I was moderating panels on behalf of the NVCA. This was 4 or 5 years ago, and I'd be in a room with maybe 60 or 80 corporate venture groups, all names that people would know, Intel Capital and Google Ventures. I'm going back to some of those same conferences now, and there's 460 or 480 corporate venture groups. I mean, Walmart and 7-Eleven and AARP. It seems as though there's been this dramatic sort of rise over the last 5 years in particular. Can you give us some numbers from your perspective as to how many corporate venture groups are out there now, and sort of what do you attribute the rise, particularly over the last 5 years, to?
Sure, great question, Jack. So I think there's twofold. We really noticed a big uptick in numbers from about 2013, 2014. It felt almost that people had got through the global financial crisis, the economy was doing a bit better, and I think corporations started to take the view that it wasn't just a nice to have to understand that open innovation world, what was happening with the startups and the disruption that they were starting to cause to establish business models, but also there was an opportunity, if they really engaged in this way, that they could drive real value to the parent corporation. So it wasn't just a risk and a disruption that they were trying to avoid. There was an opportunity set by engaging in that sort of outside world to say, hey, we can really take our corporation into newer, different, more fertile land. So Google's a great example. They used their Google Ventures arm, GV as it is now, to engage much more in the healthcare space, not traditionally an area that Google had played in. But for Alphabet, the alpha obviously is the Google, and the bets are through corporate venturing and trying to find other ideas that really might drive the future of the corporation. Again, similar to Tencent, it's kind of being known in games, but through WeChat, they created a whole ecosystem that's driving their value much more longer term. So in terms of numbers,
yes,
I think in terms of numbers, we've seen that uptick from maybe 1,000 or so corporations that had engaged, and some limited or greater extent. The Intel Capitals of the world have been doing it for 25 years. And now there's about double that number. There's about 2,500 active corporations, of which probably half that number are really active in the way that a lot of VCs would think of doing, maybe 5, 10 deals or more in any given year.
And many of these, most people who have watched through multiple venture capital cycles have seen the corporates come into the asset class and then exit the asset class and come in and exit. My view is that things are a bit different this time, and I'll tell you why, and it'd be interesting to get your perspective. It seems as though corporates have gotten much more enthusiastic about crowdsourcing R&D efforts, meaning they're working on their internal sort of R&D efforts to establish new product lines and look at new strategies, but they're also using their corporate venture programs as sort of external R&D to see what the world can come up with. And I wondered if that made corporate venture a bit more sustainable this cycle, and as opposed to just coming into the asset class when it's performing well and exiting when it's not. I wonder if research and development in major corporations is changing with the sort of addition of corporate venture as yet another strategy to allow them to identify innovation. What's your sense, James?
Sure, great. I think you're spot on there, Jack. I think Warren Buffett's got a nice phrase, which is you only really know when the tide goes out and you see who's swimming without their trunks on. So I think we'll only really know when we hit that downturn and whether this time actually is different. But I think the indications are exactly as you say, that there's certainly a greater willingness. We track hundreds of corporate venture units with more than a 10-year track record. That's consistent through an economic cycles or more than an economic cycles. And I think that people have really started to understand that if you just chop and change, if you're late to the game and you're first out, you lose money. Whereas if you can ride that way through economic cycles, you've got a chance not just to make money, but be seen as consistent to the entrepreneurs, the people who really count, and the other venture investors, and saying to them, look, we're here for the long term. We'll back you and we'll deliver for you. So I think partly there's that understanding of what venture is about. Yeah. And then secondly, I think internally they started to remodel how they think about innovation. You've got short-term value creation through M&A. You've got longer-term value creation through R&D. And then there's somewhere that plays between the two and actually makes both R&D and M&A more efficient is corporate venture capital. The delivery of CVC, of venture investing either through VCs or directly or probably a bit of both, helps make your M&A, your mergers and acquisitions, more efficient and your R&D more efficient. And this is a plus side, can deliver positive financial returns and strategic benefits as an independent unit.
Yeah, and from an entrepreneurial perspective, it's been interesting. As I meet with entrepreneurs, we meet with a few thousand entrepreneurs through the events and other direct one-on-one meetings that we have each year. And the perception has been historically that you approach one of these large corporations when you're ready to be acquired. That's the time, and that's the view. But now more and more, you look at corporate venture capital, and they're participating in 25% or almost a third of Series A rounds of financing. So there's been a difference in sort of where these corporates are participating in the financing food chain. How do you see corporates interacting with entrepreneurs within early stage companies different than maybe just at the acquisition part of the cycle?
Sure. So I think what you're seeing is, like, traditionally, exactly as you said, you saw corporations, a lot of play in the B and C rounds, which is companies that have a product, they've started to sell, to customers. Maybe they're getting towards profitability, or they've got a good roadmap towards profitability. And corporations have often sort of clustered in that space because they felt that there's something tangible that they can deliver back to those entrepreneurs. Maybe that then follows on to an M&A exit, either to the parent company or to a different corporation. And so that's been the tradition. And what I think you started to see is we track, in the first 9 months of this year, it's already been a record. It's been about corporations involved in $110 billion of venture rounds. Yeah. Whole of last year, corporations were involved in about 109 billion. So already in the first 9 months of this year, you've seen corporations involved in more deals by value, and by volume, the number of those rounds, is probably also going to be a record this year as well. But what that starts to mean is that corporate engagement has spread. It's not just at that middle B and C rounds, it's much later, much higher value rounds, the D&E rounds, maybe even $1 billion rounds, or certainly $100 million rounds. And also they're engaging much earlier. It started to be around that R&D space, what's happening out of universities, what's happening at that seed or that accelerator incubator stage. And so you're starting to see more capital and more numbers of deals going in that seed and A round that historically you wouldn't necessarily see. They're starting to say, we're not just going to rely on VCs to do that work, we're going to actively engage and actively support. I think it's really encouraging for the ecosystem as a whole.
And in your view, are they making these investments, so the corporate venture groups primarily making these investments for strategic value or exclusively for financial value? Is it some blend? How would you sort of, as a percentage, sort of say, you know, X percentage are focused on strategic value and as a secondary part of that financial value, and you know, and Y percentage are focused purely on sort of, because I know there's these independent sort of spin out corporate venture groups that seem to be focused exclusively on financial returns. What's your sense of the balance or the ratio between those that are focused on strategic value versus financial value?
Sure, it's a great question. I think no corporate venturing group is set up with the idea to lose money. It's very much felt that R&D is a cost center, a loss center, whereas corporate venture capital, the general view is that, you know, if you're backing duff entrepreneurs that aren't going to succeed and you lose money, well, they're probably not going to add a lot of value strategically anyway, because they're going to go out of business. So I think the general view is that corporate venturing covers at least their cost of capital.
Sure.
Which might be, say, 8% a year, you know, from a parent balance sheet. They might have that view that, you know, overall, if they put $1 out, they're looking for $1.08 back, you know, per year,
Sure.
you know, in that sort of general view. But they understand the venture's a 10-year plus 20-year life cycle in terms of when you make your money back. So, but then the nuance, I think, is quite an interesting what you're touching on there, Jack, is that this idea that some corporations are a bit more financial focused, they're perhaps looking a bit more like an independent VC. You know, they're trying to say, hey, we'll get the best returns we can. And if there's a strategic connection back to the parent, that's all well and good. You know, maybe there's something like a Google Ventures, good example, more independently run, trying to get the financial returns, but they say to the portfolio companies, hey, might be something at Google that will help you. You know, we've probably been through most of your pain points, given we're 20 years old and we're super successful. There might be some pain points that we can help you with, or even some research, something that we can deliver. And I think a lot of corporations are playing in that field. They say, hey, what can we bring to you from our parent company? And maybe in return, there's something that might deliver back to us. But if our primary focus is how do we serve you, the entrepreneur, better with the resources that we have as a corporate, then we think we'll make a better financial return. And, you know, down the line, there might even be some things strategically that can benefit us. So I think there's definitely a bigger shift on that way. And then equally, we're starting to see a lot of corporations starting to say, hey, how do we more directly tie what you're doing back to the parent company? Because ultimately, what will move the needle to us as a $100 billion company is if we start to change our product mix or sell more or do better as a job. So I think you're starting to see both of those equations come into more the flow. It's not either or, it's both. But that's just a reflection that the industry is so much bigger. There's so many more groups triangling along that.
Yeah, that's really helpful, James. I can tell you from, I want to talk about a market trend that we've seen. At Impact Venture Capital, we're laser focused on financial returns, but we're paying attention to kind of what is happening globally with regard to co-investors and themes, and environmental, social, and governance, ESG, is driving behavior of some of these corporations. We've threaded in elements of that into our due diligence process to really understand sort of the ESG index, if you will, of the companies that we're investing in. Can you talk a little bit? I think it's a bit of a wave of activity in Europe that seems to be making its way in larger part to the U.S., but almost driven by Europe to some degree. Can you talk a little bit about ESG and your view as to how corporate venture is taking that into account?
Sure. Well, to be honest, Jack, I think one of the reasons I was so delighted to come on your show is, you know, I think you guys are perfectly positioned for the wave of the future. If you think about venture capital as a sort of, a business model in and of itself, then understanding the big trends, the big drivers of the allocation of capital and what entrepreneurs are thinking about, is, number one. If you're in the wrong sector, in the wrong region, it's tough business to do. So I think Impact VC is perfectly aligned, because I think what we'll see in the 21st century is this move from just risk and return and how you allocate capital for those two metrics to risk, return, and impact. What are you actually doing with the money that changes the world? How are you making the world a better place? If all you do is sell more games and people get more addicted, I think there's a bit of a backlash to just that very mercenary, very low-hanging fruit type business models, the sort of 7 deadly sins, if you call it. How do you find something that fits in it, makes people, eat more or play more games? And I think understanding the impact and how you can drive the entrepreneurship, to a better place is so powerful. And I think where you're at is perfect. And I think the corporations, in particular, whether it's driven out of Europe or I think increasingly in the US as well as in Asia, all the corporations are understanding that sustainability of their business longer term comes from sustainability of business model and helping people do a better job in their lives. And I think that ESG, environmental, social, governance piece, is really driving a lot of corporations to understand what they're doing with their venture activities. So, give a great example in the US. There's Patagonia, clothing company. Their corporate venturing unit, Tin Shed Ventures, is really laser focused on things that might help deliver more sustainable clothing effectively and a sustainable business. Cox, which is a big, car business and does a lot of media. They've just set up a clean tech unit last year, run by Josh McClung. But then if you look around Europe, there's Danone, there's Sky, which is just being acquired. It's effectively a satellite business, but they've got a circular economy corporate venturing unit that's just started by Jamie Rowles earlier this summer. And I think you go along the list, even non-traditional businesses are starting to say, hey, this is important to our future. And corporate venturing is about the future. It's about what those ideas will be. And so I think this trend, this wave, isn't just a nice to have. It's not greenwashing. It's very much the allied of future capital, future entrepreneurship, changing established incumbent corporations. So I couldn't be any more excited. And I think you really are in the gold mine of the future.
Oh, thanks so much for your kind words. I appreciate it. Though, one last question that I wanted to ask you about sort of a trend that we're seeing is we've had some corporate venture groups actually invest directly into our fund. And so in addition to investing directly into early stage tech companies, they're investing into venture funds to get access to high quality deal flow that is relevant to the industry sector that they care about most. And I think it's also a way for them to bridge into the venture ecosystem. What of the groups that are out there that are investing sort of directly, how many of them are actually actively investing into funds as well as part of their strategy? Is that a small group or is that a large group? Can you talk about that trend of both direct investing and investing into venture funds?
Well, it's no surprise to me that people, corporations are committing to your fund, Jack. I mean, with Dixon Dole and yourself, you've really got a stellar top-tier team. And I think that's the fundamental first point with why corporations, like any limited partner, will want to give money to a VC to invest is the team good? Have they got a good strategy, and do they know how to find good entrepreneurs that can deliver on their promises? So that's point number one. Corporations are no different in that regard. Now, as to whether we're seeing more corporations do so, I think you're seeing, again, a twofold trend. There are just more corporations engaging in venture activity. Now, a starting point for them to learn, because it's a skill, it's a profession, it requires ability to do this well, is for them to go to the top masters of the industry and say, hey, how do we learn? How do we understand? What do we have to do? How do we engage with entrepreneurs? How do we think about how they think? How we can support them? So that wave of, let's say, 1,000 or more, 1,500 corporations that have started to engage much more over the past 5 or so years Now, naturally, a good portion of them start out, about half of them start out with engaging indirectly. They say, hey, let's talk to a VC and we'll engage in some form or other in that way. And maybe we'll co-invest alongside them in some deals, and then maybe we'll build out our own team and start to do more deals directly. So that's probably a good chunk. The other half, the established groups, like say Cisco, there's not much you can tell Cisco about venture investing or understanding entrepreneurship, but they still really commit to a lot of VC funds because there's either regions or markets or segments that they think, hey, it's a quick way for us to really understand what's going on in that ecosystem. What's happening, what are some of the issues, and then maybe we could do more directly or work more. But engaging with top quality VCs is a no-brainer for most corporate venturing groups. They find some way of saying, hey, we'll find the right team and we'll back them. We'll give them as much money as we possibly can for them to do the best job that they can do, because we know they'll help the entrepreneurs and they'll help us. It's a win-win for everyone.
I've been amazed at how much our team has learned from corporate venture groups, gathered market insight on where they're interested in investing, where they want to partner, where they want to acquire companies. The third founding partner at Impact is Eric Ball, who spent a long time at Oracle and was there while Oracle gobbled up 100 different companies. So he's just got tremendous experience in looking at sort of how corporates analyze M&A strategies and sort of how they pick companies. So we've learned not only through previous experiences, but now with our strategy now of engaging with these corporate venture groups, where they might be interested in partnering or investing or in acquiring. And I think it's ultimately elevating our investing IQ. So I've really appreciated not only the direct experiences that we're getting now, but candidly learning from thought leaders like you. So I'm going to shift now to a rapid fire session. My team is telling me we've got to wrap up here in the next couple of minutes. I'm going to ask you a couple of rapid fire questions just to round out the interview today, if that's okay, James.
Sure, shoot, go for it.
So, 2019, do you envision the number and amount of investing by corporate venture capital being flat, a bit lower, or maybe a bit higher? What's your forecast for 2019?
It's definitely up. There's more money allocated, therefore there'll be more deals done. Unless, obviously, nuclear Armageddon or massive trade war just stops the allocation of capital. But those provisos not happening, definitely up.
Do you have a bold prediction for a change or some new market trend in corporate venture that you think is going to play out over the next year? We won't hold you to it, but we're interested if there's something that's been kind of stewing or you've been thinking about a little bit that you think might play out in the next year or so with corporate venture.
Sure. We're starting to see much more merger between corporate venturing within the venture ecosystem and within that venture ecosystem into the private capital markets, how they interact with private equity firms as well as some of the hedge funds. And I think what you'll start to see over the next 12 months in particular is that engagement between those communities and how those private and public markets, as stock exchanges, start to interact much more with the private markets. And I think what that will mean is that the amount of capital available is only going to increase, but how smart investors really use the tool set of financing structures to support entrepreneurs will increase. When you have Uber talking about maybe $120 billion IPO, when you talk about some of these private companies being more valued than the entire public, peer equivalents, then I think what you'll start to see is this wave of really smart financial investors coming down into the private markets much more than they do so now. SoftBank is only the start.
You put out some stellar information, and you're clearly one of the thought leaders that's publishing valuable information for the ecosystem, and I really appreciate that. I'm interested personally, are there other blogs or articles or media that you pay close attention to that have enlightened your perspective on corporate venture outside of your day-to-day activities at GCV?
Sure. I mean, the best insights always come from the practitioners, those at the coalface, those trying to engage with the entrepreneurs. Sapphire does a really good job understanding the limited part of the world, how you engage with that flow. I don't know, but at least we're trying to understand what people are doing. And so it's very humbling to realise how much further we've got to do to really, fully understand just the great work that these folks do.
James, when's your next event? I've really appreciated not only the publications, but I know you run some great events as well. When's the next one that's focused on corporate venture?
Sure. Well, we've got 3 that's coming out very quickly, actually, Jack. We've got New York on the 2nd of November. We've got Houston, bringing together a bit more of the university ecosystem and the corporations, particularly around energy and health. And that will be the 8th and 9th of November. And then our largest one, perhaps no surprise for those in California like you are, Jack, is down in Monterey. And that'll be about 750 people, about $6 to $10 trillion of aggregate annual revenue from corporations who attend, and about 200 billion of venture assets under management. That will be on 30 and 31st of January next year. So that will be a real who's who gathering of the world's corporate giants. Well, Jack, I was honoured and delighted to have been asked onto this program. I think the work that you and Dixon and Eric have been doing at the firm is just fantastic. I think this series of video interviews is just wonderful, and obviously I learned a huge amount from hearing the pearls of wisdom from you. So anything we could do to help, Jack, you let us know.
Thanks again, James.